Hello, everyone, and thank you so much for joining us today for Social Security and Medicare. My name is Chad Narani. I am a retirement plan consultant here at BFSG, working with several of our institutional, for-profit, university, and government municipality clients. I also have on the line a few of our financial planners. Mike, do you want to take a moment to introduce yourself?
Yeah, thanks, Chad. So I'm Mike Allbee, a certified financial planner with BFSG. I'm also a senior portfolio manager. I've been working at BFSG for 16 years, helping clients try to achieve their goals and objectives.
Thanks, Mike. And Mr. Arash.
Hi, everyone. My name is Arash. I'm a CPA and a certified financial planner. I'm one of the financial planners here at BFSG. I'd like to thank everybody for joining us today.
Thanks, Arash. And we also do actually have Paul Horn. He's not going to introduce himself. You guys have heard from him in 2 webinars in this series already. He's mostly here. When we get to the Q&A, we want to have as many of our financial planners on the line to tackle all of your really important questions at the end of today's webinar. So with all that being said, Mike, Arash, are you guys ready to kick us off?
Yeah, and it's nice to have Paul join us as well, because there's so many different ways Social Security and Medicare can go, a lot of different options, optimization for these, and different plans you can get for Medicare. So we're going to dive first into Social Security. So really, Social Security is looked at, it's a foundation for planning for your future. Social Security benefits were said to be one leg of a 3-legged stool, consisting of Social Security, private pensions, and then savings and investment. The metaphor was intended to convey the idea that all 3 approaches were needed to provide stable income security in retirement. Unfortunately, today, many employees do not get pensions anymore. So one of those legs of the stool has been lost for many employees. And so it's even more important to save and invest in retirement plans and so forth. And according to the latest report by the trustees of the Social Security program, over 65 million people received some type of Social Security benefit in 2021, and that totals over $1.1 trillion. So obviously, Social Security has become an integral financial consideration for most Americans. And let's dive a little deeper into that. When we look today, for all retired workers, the average monthly Social Security benefit is $1,657. Many people who just rely on Social Security when they reach retirement may have a surprise and a shortfall to cover their expenses. When we look at this chart here, lower earners, as represented on the left-hand side of the chart, receive a greater percentage of their pre-retirement income than higher earners from Social Security, as represented on the right-hand side of the chart, the higher earners. And that purple shading is what the benefit is from Social Security. So again, for higher wage earners, especially those over the Social Security wage base of $147,000, Social Security will replace a much smaller percentage of wages. Today, the maximum monthly benefit for someone at full retirement age is $3,345. So let's look at an example. Someone making $100,000 in pre-retirement income right there in the middle of the page. And that person is going to get approximately 38% from Social Security. That's going to get replaced of those wages. They'll need to make up roughly 41% of their pre-retirement income with the other leg of the stool, savings and investments. So how are your benefits calculated? To fully qualify for Social Security, you must have 40 quarters of coverage. It's not possible to earn more than 4 quarters in any one calendar year, no matter how much you earn. For 2022, you must earn $1,510 in the quarter. Therefore, you must earn at least $6,040 each year for 10 years to fully qualify at retirement for Social Security benefits. Social Security then takes the best 35 years and drops the lowest 5 years. It's always possible to increase your benefit by improving your earnings record, even after you started receiving your benefit or if you're delaying. If you earn enough to knock off one of those 0 or low earning years, then your benefit may go up a few dollars. Your Social Security statement is online. They used to mail them. They don't do that anymore. It's online. And it will show you what your estimated benefits are at various claiming ages, which we'll get into in a little bit. And it's also going to show you if you've got any zeros that would reduce your benefits. If you find that there's an error, you can bring in your W-2 to Social Security and they'll adjust it accordingly. The Social Security website has a benefit calculator that can be used to estimate your Social Security benefit as well. And that's where you get your statements as well as at ssa.gov. So Chad, I'm going to kick it back to you and we'll do our first poll.
Yeah, awesome. Thanks, Mike. So again, for all of you that are familiar with our webinars here, I have just launched the poll, and this is just a quick gauge for our financial planning team to see what the audience thinks is when, at least today, are you currently planning to take Social Security? At what age? Age 62, full retirement age, that's 67 for most, age 70, or sometime even later. Let me leave that up for just a couple moments while we gather responses. With most responses in, let me close polling. I will share results with the group. It looks like we have around 17% saying age 62. Most people, almost 60% saying full retirement age, another 21% saying age 70, and only 2% of our audience says sometime after age 70. Thanks, Mike. Let me give it back to you.
Yeah, I think that last one is a trick question. But go ahead, Arash. I'll let you kick off with the various ages.
Great. Thank you, Mike. It's nice to see that most of our audience want to take it after full retirement age or at full retirement age. So let's talk about full retirement age. This slide is going to cover that topic. So on the left-hand side of the slide, we're going to see the ages for full retirement age. This is the age where you will receive your unreduced Social Security benefits. So for those born before 1954, they will reach full retirement age at 66. And those born from 1955 to 1959 will have to add 2 months for every year to your full retirement age. So as you can see, if you were born in 1955, your full retirement age would be 66 and 2 months, 56 would be 66 and 4 months, and so on. For those born after 1960 or on 1960, they will reach full retirement age at age 67. So why does that matter? It matters because it determines how much monthly benefits you will receive from Social Security. So as many of you know, you can start taking Social Security at 62, or you can delay it up to age 70. So on the right-hand side of the slide, we're going to look at an example. So if you reach full retirement age at age 66, and then you will receive 100% of your benefit if you start taking it at full retirement age at 66. But if you decide to take it earlier, let's say earliest you can at 62, your benefits will actually be reduced by 25%. So your monthly benefits will be 75% of the Social Security benefits that you had. So you will get reduced. However, if you decide to delay receiving your Social Security benefits, your benefits will actually go up 8% after your full retirement age at 66. So you can see at 67, your monthly benefits will be 108%. And at 70, your benefits will actually go up by 32% in total. And keep in mind, there is no benefit in delaying receiving your Social Security checks after age 70. So you definitely want to take it at age 70, and that would be the highest amount of that you can receive. So a question that comes up quite often with our clients is when to take Social Security. When to take Social Security, and that really depends on various factors like your life expectancy, your longevity, and your finances. So none of us have a crystal ball. We don't know how long we're going to live, but you can take a look at genetics actually play an important role. So you can take a look at your family's health history, how long your parents or grandparents have lived, kind of give you an idea of how long you may live. And also your finances could play an important role. So that's something to consider. Do you have enough finances to delay receiving your Social Security? There is an analysis, as we can see in our screen here, called Breakeven Analysis. So what we're looking at a total lifetime Social Security benefits received for an individual if they had taken it at 3 different ages, at 62, at 66, or delaying it to age 70. So if this individual took it at 62, where they will receive their reduced Social Security benefits, where their benefits will be 75% of their monthly benefits, they are better off up to age of 77. Because at that age, had they delayed receiving their benefits to their full retirement age, they would have received total lifetime Social Security benefits at a higher total lifetime Social Security benefits going forward. Had they delayed it to up to age 70, then if they live past age 81, then they would have been better off if they had delayed receiving Social Security up to age 70, because their lifetime Social Security benefits would be the highest. Keep in mind that this analysis was only looking at the math. So it's only looking at your Social Security benefits. It's not looking at individual specific situations, such as their taxes or any of their finances. So it's purely looking at the math, and you may be better off taking it at various ages. So one way that we help our clients make this decision is by putting together a financial plan. We'll take a look at their income, their assets, and their expenses, then we'll help them make that decision.
Yeah, and I think you mentioned it, Arash. The largest unknown is we can't solve for a person's specific life expectancy and what that is. Again, we wish we had that crystal ball. Another consideration also is just the quality of life and the activities based on age. Many people, I mean, are more active and travel more right at retirement. So maybe you want to be funding that lifestyle. But again, it really comes back to your specific situation.
Definitely, that is the case. And another topic that actually comes up quite often is taxation on Social Security. So how much of your Social Security benefits is going to be taxable? So there's actually an IRS formula that is used to determine this. On the left-hand side of the screen, on the top, you can see this formula. They take your adjusted gross income, or commonly known as AGI, without the Social Security benefits. Then they add the non-taxable interest that you have. Think of municipal bond interest, and half of your Social Security benefits. Then that total is called the combined income. On the right side, at the bottom, we can see tax brackets. So if your combined income, and you're an individual tax filer, if your combined income is under $25,000, then none of your Social Security benefits is taxable. But if your income is between $25,000 to $34,000, then up to 50% is taxable. If your income is over $34,000, then up to 85% of your Social Security benefits could be taxable. On the right-hand side, we can also see the tax bracket for married couples. It's just slightly higher. But please keep in mind that when we say 85% of your Social Security could be taxable, that doesn't mean that you're going to get taxed at 85%. That means that 85% of your benefits will be included as part of your income, and you have to pay taxes on it. So you could very well still be in the lowest tax bracket and pay perhaps 10 to 12% for federal taxes.
Yeah, I think that's important. Thanks, Arash. So when we look at various opportunities to maximize benefits, each individual's circumstances must be considered when considering a particular strategy, such as your health, your family health, as we talked about with longevity, your financial need, other sources of income, going back to that three-legged stool, what savings and investments do you have to get you to delay Social Security, and then marital status as well. So when we look at the top in the green, a strategy we've already talked about is just claiming after full retirement age. Individuals who wait past that full retirement age, 66 to 67, depending when you were born, get an additional 8% per year in projected benefits. As we learn, that 8% each year is not compounded. However, the cost of living adjustment is applied and is compounded annually. So life expectancy tables show that an average person who has attained age 62, the first year when you can start taking Social Security, that person who reaches age 62 has a life expectancy they're gonna reach 85 and a half. An average person who has attained age 66 will live to be 86 and 2 months. So that statistic argues to claim after full retirement age. Remember though, no one is actually average, and it really depends on your situation. If you have already started collecting your Social Security benefits before full retirement age, you can withdraw your application within 12 months from when benefits were first started, repay those benefits, and then reapply for benefits later. But it's only that 12-month window when you started to apply it. So just recently. So let's look now at strategies for married couples. And first, we're going to tackle the spousal benefit, and we'll explain how that works. So spouses are entitled to the greater of their own benefit or the spousal benefit. Again, that's the greater of their own benefit or the spousal benefit. The spousal benefit is 50% of the higher earner's benefit, and then that's capped at that person's full retirement age. So there are a couple things to note. A couple must be married for at least 1 year. The spousal benefit can't be claimed until the higher earning spouse files. And like individual benefits, spousal benefits can also be collected at age 62, as shown on the chart there, that purple bar. But they are also reduced and up to 35%. So it argues to wait to collect so the spouse can get a higher benefit. And again, let's look at an example. There's strategies around this. For example, a married couple with a larger age difference. If one spouse has earnings and the non-wage earning spouse is under age 62, then the couple would benefit from having that wage earning spouse delay filing and waiting to collect their benefit until the younger non-wage earning spouse reaches age 62. Remember, the amount of the spousal benefit depends on when the higher earning spouse applies. Conversely, if the non-wage earning spouse is 4 or more years older than the wage earning spouse, it might be beneficial for the wage earning spouse to begin his or her own benefit as soon as possible at age 62, so the non-wage earning spouse can start to collect. And that's just one example of a strategy for spouses. There's plenty of other ones as well on the timing of filing. And then the other benefit for married couples is the survivor benefit, as noted on the bottom there. For married couples, waiting also increases the survivor benefit. So even if the worker dies before collecting the increased benefit, his or her spouse will receive a higher benefit. Widowed spouses may be entitled up to 100% of their deceased spouse's benefit. Widower benefits are the only benefits that allow for changing between your own benefit and a survivor's benefit. So for example, a widow can claim his or her own reduced benefit at age 62 and then switch to the survivor benefit at full retirement age. There's a couple of caveats, just like the spousal benefits. A couple must have been married for at least 9 months. The surviving spouse must be at least age 60 to begin receiving survivor benefits. And that's considered early filing again for a reduced benefit of up to 28.5%. And then a widow's survivor benefits are only available if he or she does not remarry or remarries after age 60. And the final thing to note is the Social Security Administration will not notify you of your eligibility for survivor benefits. So it's really important to know this ahead of time and have a plan in place. So I went through a lot right there, and we can dive deeper into those strategies during a Q&A session as well. So I'll just briefly touch on the windfall elimination provision and just something to be aware of. It's also known as the WEP, and it affects any individuals who have a pension and also had a prior job where they paid into Social Security, where their Social Security amount may be reduced. In 2022, the maximum reduction is $512 or 50% of your pension, whichever is less. So just again, note, if you have a pension and you also worked at another job where you paid into Social Security, that Social Security amount may get reduced a little bit.
Great, thank you, Mike.
Yeah.
Here we are going to start talking about the second topic of our webinar, Medicare. So majority of people who sign up for Medicare or eligible for Medicare are generally happy with the services they receive. They can see the doctors they like, the premiums are generally low, but the challenging part seems to be the enrolling in Medicare. First of all, you know you're getting closer to 65 and you're eligible for Medicare because you're gonna get bombarded with mail, phone calls or emails from different brokers or healthcare providers trying to sign you up. So they definitely make sure you're aware of that. The becoming eligible for Medicare, there are certain requirements that are very similar to Social Security. So you have to have at least 10 years of work experience or 40 quarters that Mike mentioned earlier. You have to have been a citizen or a legal resident for at least 5 years, consecutive years. There are other conditions. If you're disabled or have health conditions, you may be eligible for Medicare. It could also be eligible for Medicare based on your spouse's work record. So if you have been married for at least 1 year, then you're eligible for Medicare based on your spouse's work record. If you have been divorced, but you were married for at least 10 years, then you would be eligible as well. And also, if you're widowed, but you've been married for at least 9 months, then you could qualify for Medicare as well. When it comes to enrolling in Medicare, which is a challenging, seems to be the challenging part, you have a 7-month period. The enrollment begins 3 months before the month of your birthday, the month of your birthday, and 3 months after the month of your birthday. So you have that 7-month window to enroll. And it's very important to enroll in that period because if you don't, then your premiums for Medicare Part B could go up by 10% for every 12 months that you were eligible. And this penalty, unfortunately, is not reversible. So you could get stuck with this penalty for the rest of your life. So that's why it's very important to make sure that you enroll in a timely manner. If you don't, then you can enroll in a general enrollment period that starts from January to end of March. And then your coverage will begin in July 1st, and you could get penalized that I just mentioned. And also you may have gaps in your coverage. However, keep in mind that there is something called a special enrollment period for those that are still working and are covered under the employer's healthcare plan or spousal healthcare plan. And if that healthcare plan and employer qualifies, for example, they have more than 20 employees and they have substantial coverage, then you can delay receiving Medicare until you retire from that employer. And then you have an 8-month window where you can apply for Medicare and avoid any penalties. So it's very important to make sure that you enroll in Medicare in a timely manner.
Yeah, thanks, Arash. That's really important. And then I think the next most important thing is what are your going through your choices and seeing if you need additional coverage. So let's first start with what original Medicare is and what Arash just talked about of enrolling in that. They're mainly Part A and Part B. An easy way to remember A and B is A typically covers anything that requires you to stay at the hospital. Hence the little bed image there next to Part A on the left. Part B covers most outpatient services. So let's dive a little deeper into Medicare Part A. Again, Part A provides inpatient care in hospitals, skilled nursing, facility care, hospice, and home health care. There's no premium for Part A, assuming you paid Medicare payroll taxes while working, again, as those 10 years or longer, and you can't be denied coverage. The important thing to note is Part A does not cover long-term care. Paul talked about that on our first webinar series and options for that. So if we now dive into Part B, again, Part B helps cover medically necessary doctor services, outpatient care, home health services, medical equipment, and other medical services. Part B also covers preventative services, and you pay usually nothing for those preventative services. Part B does have a premium though, a monthly premium, and that's adjusted for income. Part B premiums will be higher for those with a modified adjusted gross income over $91,000 if filing single, or $182,000 if filing jointly. And again, you can't be denied coverage for Part B either. So that takes care of step one, enrolling in original Medicare. After you've enrolled in that, you need to decide if you need additional coverage. Since original Medicare includes deductibles that could lead to significant out-of-pocket expenses in retirement, many retirees opt for supplemental insurance to cover these costs. When looking at Medicare options, understand that there are essentially different routes you can take to get to the same destination, which we have listed here as option 1 or option 2. One is through Medicare supplemental insurance plan, or alternatively, you can add drug coverage to an original Medicare plan, or better known as Part D. Part D for drugs. So you must have Part A or Part B to join a Medicare prescription drug plan. The second way to obtain Medicare prescription drug coverage is through a Medicare Advantage plan. That's option 2. Also, what this does is really, it's Part C, which combines Part A and Part B into one plan, and then includes Part D as well. So let's dive a little deeper into the Medicare Supplement and Medicare Advantage plan and what the differences are. So first, we're going to focus on Medicare Advantage, or Part C. They generally limit you to the doctors within either the HMO or the PPO and may not cover any out-of-network care. Part C plans may offer additional benefits such as vision, dental, and hearing, again, which Part A and Part B do not cover. Alternatively, some retirees opt for original Medicare and then purchase a separate Medigap policy to cover at least some of the out-of-pocket expenses. On the last slide, I said Medicare Supplement. Medigap policy is the exact same thing. MedSup, Medigap is the same thing. For a Medigap policy, you pay the private insurance company a monthly premium for your Medigap policy, in addition to the monthly Part B premium that you pay to Medicare. A Medigap policy only covers one person, and there are no higher premiums for those with pre-existing conditions who are enrolled during the open enrollment period. Any standardized Medigap policies is guaranteed renewable. What that means is the insurance company can't cancel your Medigap policy as long as you continue to pay the premiums. Medigap policies don't always cover vision or dental or hearing. So you got to make sure you know what you need, and there's various plans. So which plan is best for you? It really depends on your situation and what services you're looking for. So with that being said, we covered a lot of ground in a very short period of time, and we could spend hours on Social Security and Medicare. As you can see, it's pretty complex. We always get a ton of questions on both of these topics. We've got a team of certified financial planners who all act in a fiduciary capacity, always putting our clients' best interest first. Everyone on our team has at least 10 years of experience in financial services. And Chad, why don't you lead us out with the next steps and the Q&A?
Great. Thank you so much, Mike and Arash. Great presentation. I know a lot of content. We actually do have quite a few questions in the Q&A box. I'm going to do based on the thumbs up. So again, for all of you attending on the computer, if you pull up the Q&A box to type in any questions you have throughout our Q&A session today, there's also a number of questions in there. I encourage you to thumbs up the ones you think are most important, and we can address them first. But Mike, while we get to that question, one of the early ones, can you go back to slide 3 real quick and pull up that first chart you showed, which is like Social Security based on like income levels?
Yeah, this one.
Yep. Awesome. Okay, so while we have that up, I think that does answer one of the questions we already have in there. Can you address kind of, like, there's a couple questions on this. Is first, what if someone doesn't work a full 40 years, right? How do they calculate the Social Security benefit?
Yeah, so I mean, going back again to the earnings record, it's not 40 years, it's 40 quarters, which is 10 years. So that's what you need is the 10 years. Social Security is going to look at the best years on your earnings record. But again, it's 40 quarters, not years.
And you should regularly look at your statement every year, make sure the information is accurate. And also, if you see you're less than the 40 quarters that you need, you just perhaps get this part-time job just to meet that requirement, and then you will qualify for Social Security. So it's a good idea to regularly check your statements.
Awesome. And so I think the other one that goes right along with that is like, so even noting it's not 40 years, like say someone does, how are those quarters determined, right? I think you've addressed this, basically the highest earning quarters.
Yeah, they take the best years and drop the lowest years. It's the best 35 years and drop the lowest 5 years. Yeah, I mean, it's what they'll do on the statement, as we show here, is they will estimate. It's a pretty complex calculation. I don't know if Paul or Chad want to, or Paul or Arash, you want to chat about the calculation with the insurance and how that's calculated, but it is estimated on your Social Security statement.
Yeah, the only thing I would add is if you have less than 35 years work, the years that are less, so let's say you work 30 years out of 35 years, the years that you don't have there, so that would be 5 years in that example, that are just going to show as zeros in the calculation that Social Security uses. So if you don't have a full 35 years, that can pull down your Social Security benefit that you would receive otherwise.
Thanks, gentlemen. So we got a lot of thumbs up coming in here. So this is actually great to see. So the most popular question we have right now is, how do Medicare and Social Security work if you were to move internationally? Assuming I'm guessing it's the case, you have say in retirement, but maybe address if you were to do it, towards the end of your working life as well.
So when it comes to Social Security, you will still receive your Social Security monthly benefits. If you move abroad, there is a lot of tax treaty with different countries, so there shouldn't be a problem. But for Medicare, I don't believe Medicare would be helpful for you if you're abroad. You can use your Medicare benefits to cover your health expenses, from what I understand. Unless Mike or Paul,
Yeah, I think, I mean, when you look at especially Medicare Supplement, Medicare Advantage, I just put it up on the screen here. If you travel frequently, Advantage plans generally do not cover travel outside of the US. So that's something to be aware of. So from a travel aspect, yeah, from living there, yeah, I think you're right, Arash.
So if you're living there, yeah, Medicare doesn't really apply. You're still going to want to keep Part A because that's free.
Yep.
So you're still going to want to be enrolled in Part A. You're probably not going to even keep Part B at that point. And probably going to have you're going to have to get some other form of insurance because the MedSup or the Medicare Advantage wouldn't work either.
Yeah.
Not unless you're coming back to the States on a regular basis.
Okay, next question. If you were to retire at age 60 and don't pull your Social Security until full retirement age, do those last 7 years count as zero against the 35-year calculation?
Yes.
Like zero income?
Correct.
So yeah, so an important thing there is that I'm assuming.
Well, sorry. Let me rephrase that.
Yeah.
If that's 7 years in the 35-year calculation, so if that means you only work 28 years out of 35 years, then the answer is yes, you get zeros for those last 7 years. Age 60, I'm not sure where that would come into that calculation because we can't really begin collecting until age 62.
Yeah, I think perhaps they mean that what if they decide to retire at age 60 and they do qualify for Social Security, have had their 40 quarters, would they be negatively impacted for not working for past 60? Which would be no. As long as you have qualified for Social Security, they will just look at the best 35 years. So it doesn't matter if you decide to retire early, as long as you qualify by having worked 10 years.
Yeah, so let me combine those two answers. Yeah, I think what I'm hearing is if you've worked less than 35 years, then to get to the 35-year calculation, yes, they would include those years as zeros from an income. But if you've already worked more than 35 years, they will not, because they're only going to count your highest 35 years of earnings. And obviously zero would not be one of those highest years of earnings. So, once you've worked 30, say you start working at 22, right? You need to work until, if you worked until age 60, you would have more than 35 years already of at least some earnings. So those last 7 years would not count.
Good summary, Chad.
Okay, next question is, how much money can one earn after official retirement and still receive their full Social Security allotment based on age of official retirement and taking benefits? I think if somebody gets a part-time job after, once they've retired, they start taking Social Security, how much money can they earn in their part-time job and still receive their full benefit, if any?
So regarding that, what happens is that, let's say you're retired, but if you start taking Social Security at 62 and you're still working part-time, then you will receive your benefits, but it will be reduced. Social Security will reduce $1 of every $2 earned over 19,560 for this year. But if you reach your full retirement age, so let's say your full retirement age is 67, at that point, you will receive your full if you start taking Social Security, you will receive your full Social Security benefits and you can continue working and not be penalized. So that's something to keep in mind. So to answer that question, at full retirement age forward, then you can still work and receive your Social Security without having your Social Security reduced.
Thanks, gentlemen. So next one comes into just states and how they tax Social Security. Are there any states that don't tax Social Security income? I think this person knows for sure that South Dakota might not. Can you clarify any of your responses?
I don't know on each state.
Yeah, there are several states that they don't tax Social Security. I believe South Dakota is one of them. Then we have Washington, Texas, Tennessee, Wyoming, Nevada, Florida, and Alaska.
Look at you, Arash. You know everyone.
I pulled
That's
up the
impressive.
So it's one of the benefits of having that CPA behind his name too.
Yeah, for sure.
I think it's an important thing, especially when you're thinking about retiring and where you might be moving, right? This is why the CFP team does a Social Security analysis. They often will work with your accountant and your estate planning attorney to kind of button all these things up to make sure you're doing the most efficient things possible for yourself. So the next question we have is, if your older spouse has already started taking Social Security, younger spouse will have a larger payout. Can the older spouse stop taking and get part of the younger spouse's payout? Or was the payout for spouse 50 and 100% for the claimer? Can you guys clarify any of that?
Yeah, for the spouse. So they're talking about the spouse. Actually, let me jump to a different one. The spousal benefit. So the spousal benefit is for the person to either they can claim the greater of their benefit or the spousal benefit. That spousal benefit is up to 50% of the higher earners benefit, and it's capped at the full retirement age. So, and as I mentioned before, that spousal benefit can't be claimed until the higher earning spouse files for benefits. So that higher earning spouse has to be filed for benefits. Chad, do you mind repeating the question one more time just to make sure I answer that?
Yeah, so part of it was it's the older spouse already retired, younger spouse is going to have a larger payout. Can the older spouse who's already started claiming stop taking and claim the younger spouse's payout? And what I think I'm hearing you say no, because that younger spouse's payout can't be claimed until they start claiming either way.
Correct.
Cool. And then I think the last part of that was the payout for spouse 50%, 100% for the claimer. And I think that is on the screen today, 50% of the higher earning spouse's benefit.
Yeah, and this little box shows, a little example of again, it's the greater of the spouse's benefit or up to 50%.
So the next one is, can you go back to that Windfall page again and help maybe talk through that one more time for the audience?
Yeah. So without getting into the calculation, it's just if you've got a pension, say you worked 20 years and you earned a pension, and you did not pay into Social Security during those 20 years, and then you worked for another 15 years at a different job and you were eligible for Social Security benefits because you paid into Social Security. When you've got both of those situations, your Social Security amount may be reduced by this windfall elimination provision. The maximum reduction in 2022 is $512, or 50% of the pension, whichever is less. Let me jump to one other slide too. So again, I won't go into the entire calculation. You can see us afterwards. Also, that source right there will explain it more. But the substantial earnings, I mean, you have to have over 27,300 to start getting reduced. And you can visit again that website. There's also, let me chat, I'll send it over to you so you can post it. But there's to see the maximum amount that you're going to get reduced. There's a calculator for that, and we'll post it in there. But just again, if you have a pension and then you also had another job where you paid in your Social Security, your benefit may get reduced.
Yep. Thanks, Mike. The next one we have in the queue is, so my spouse is a stay-at-home mother or father. We've been married for over 30 years. Can this other spouse get Medicare?
Yes. If you've been married over a year and you qualify, if your spouse qualifies for Medicare, then you qualify for it as well as the stay-at-home.
Awesome, great. That was quick and easy. So next question, also on Medicare. Can Medicare Advantage charge higher premiums for pre-existing conditions?
I believe that's the case. If you have pre-existing condition, what generally we recommend is try to, when you get you are eligible for Medicare at 65, it's good to take consideration of obtaining a Medigap policy, because if you, in your initial enrollment period, if you have pre-existing condition, if you get Medigap policies, then they cannot deny you when they do the underwriting when it comes to pre-existing condition. But after that initial enrollment period, certain healthcare providers, when it comes to Medigap policies, they can deny you coverage. When it comes to Medicare Advantage, I believe they can deny the coverage as well, or charge higher premiums, unless Mike and Paul, you know.
No, that's my understanding with the Medicare Advantage as well. Yeah, you can get definitely, I mean, it's higher premiums for sure. Again, these are, I mean, private alternatives not offered by the government.
Thanks, gentlemen. So next question is, does Social Security still require an ex-spouse to be married at least 10 years in order to collect the ex-spouse's Social Security benefit?
So for a divorced spouse, yes, a couple must have been married at least 10 years and divorced for at least not 2 continuous years. And that person has not remarried before age 60.
So very specific requirements on that one to be able to claim that.
Yeah, that's why we have a slide for it. I didn't touch on it, but yeah, it's very specific as far as divorced spouses. Just, I know the question wasn't asked, but for divorced widowed spouses to get the widower benefit, the general conditions, you can see the list here. The surviving former spouse must be 60 or older. The marriage must have lasted for at least 10 years. And then remarrying before age 60 makes the spouse ineligible. So there's different rules for divorced and divorced widowed spouses as well. Again, these are all in the slide deck. We didn't cover them specifically, and I just went through a lot fast, but everyone will get a copy of this after the webinar.
So the next question is back to Medicare. If I sign up for Part A and still working and have employer-provided health insurance, can I use both, or do I need to choose which one to use? Great question.
Typically, you're going to be automatically enrolled in Part A. And then you're typically going to use, if you keep your employer's health insurance, that would be the primary. And then I think social, yeah.
Yeah, that's what I was going to say, is typically if you have your own insurance, that's going to be the primary, and that's where it's going to default to first.
You guys, so we still have a ton of great questions. I'm going to keep running with these things, but just for everybody on the line, I know some people might have to drop as we get close to the top of the hour in 15 minutes. I did post a link to a 1 to 2 minute survey. There has been a lot of content in the slide deck. And as you can see, Mike's put a lot of stuff behind the thank you slide as additional resources to help address some of these questions too. So I did actually post a link to the slides in the chat box as well that would allow you to download it. This will all come out in an email tomorrow to all attendees as well, along with the replay link. So if you do not, or if you're unable to grab it from the chat box, it will come out to all attendees tomorrow that signed up with an email address. The next one we have in here, my next question is, if you were to take the full benefit before full, or take your benefit before full retirement age, That means you forfeit your 8% increase every year.
Yeah, and you actually lock in, let me jump back, lower returns. I mean, you receive, as Arash kind of walked through on the chart on the right, say, for example, the full retirement age of 67, you see 100%, and then it goes up 8% every year. Past that, you wait. If you claim before then, you're receiving less of your benefit, up to, I mean, 30%.
So the next one we have is, think how much in advance of retirement does someone need to, or should they file for Social Security and Medicare benefits? I think let's address those separately. So first, I think Social Security is probably like when you can afford it, or when you need the money, like wait as long as possible in most cases. Medicare is very prescriptive for when you need to apply for it, correct?
Yeah,
Correct.
Social Security, you should have a plan of, I mean, when you should have a financial plan and understand what's your best strategy based on your specific needs and goals. And again, some people, if they have bad genes and they know they just family members or depending if they were a smoker, whatever their own situation, may want to collect Social Security earlier. But having that plan in place, or if you don't have assets to draw from and you need the funds, but going to Medicare, I'll jump to that. Arash, you want to cover the enrollment one more time?
Sure. So for Medicare, of course, you have the 7-month window that we just went over to apply. But if the question is that you want to file, for example, full retirement age, if you're asking how long in advance of full retirement age should you decide to apply for it, then for Social Security, it's a good idea to at least a couple months to reach out to them, let them know you want to apply to make sure you start getting your benefits on a timely manner. And when it comes to Medicare, if you're already receiving Social Security, you are going to get enrolled in Medicare at age 65 on the the first day of the month of your birthday. You will automatically get enrolled. But generally, you want to at least do it a month before your birthday month, so you get the coverage on the month of your birthday, there is no gap in between your coverages.
Okay, next question for the group is, are your savings not considered taxable earned income? I think this goes back to not just Social Security, right? Social Security we know is taxable, in most cases. But can you talk a little bit about your savings? And I think this is a big, it depends, right? It depends on how your savings, right? Is it, pre-tax savings in like a retirement account, like a 401k or IRA? Is it Roth savings, or is it a taxable account? There's a lot of different ways. So I think that it's a loaded question with it depends.
Yeah, so if you're just referring to your savings account, whether the income from the interest that you receive on the cash that you have sitting there, if that's considered taxable earned, that's not considered earned income, but it is a taxable income and it's considered part of your income. But earned income is only from the workplace.
Yes, I think when it gets, probably the easiest way to summarize that is any money you have just sitting in a savings account, right? Like your checking account, savings account, or in some brokerage account that you're investing with, right? With after-tax money is never going to be taxable again, right? But the earnings and interest on those accounts would be taxable in the year that it's earned. Anything you have in a retirement account, like an IRA, a 401k, 403b, 457, would depend on how you saved it, right? So if you saved it on a pre-tax basis in retirement, it basically becomes like your new employer. So think right now you work for company A, you're saving in company A 401k plan. The day you retire, you no longer get a paycheck from company A. You now get a check from your company A 401k plan. And if you saved in a pre-tax bucket in that plan, that is now your new earned income, and it would be taxable the same as your wages are taxable today. Very similarly to how your wages are taxable today. You have a couple less like FICA taxes stuff. If you save in a Roth account on the other end, either Roth IRA or Roth in your employer sponsored retirement account, that including any earnings on that account, assuming it's been open for at least 5 years, would not be taxable in retirement. So no earned income, because you basically already paid taxes when you contributed to that Roth account. So it definitely depends on what type of account you're pulling money on and what type of savings vehicle it is, whether it will be considered taxable in retirement or not taxable in retirement. Anything to add there from that summary, gentlemen?
I think we're good.
Okay, so the next one goes back to, it's back to that 40, we talk about 40, we talk about 10 years, 40 quarters, 40 years, 35 years. And I think, we have a couple people on here that, we should clarify that a little bit. So let me try to summarize real quick. Can you put that slide up real quick?
Yeah, so I was getting back to it.
And so I'll try to use years instead. Like when we say the first one was 40 quarters, which really adds up to 10 years. And that is to even qualify for Social Security, you need to have at least 10 years of earned income in the United States. Whether it was $1 or $1 million, you need to have that 10 years, which is that 40 quarter statistic. Once you've hit that 10 years to at least be eligible to receive a Social Security benefit, then you jump to, well, how many years are going to actually be counted towards that benefit? And that is your best 35 years. So you might work another 40 years, another 45 years, another 50 years. Your best 35 years of earnings in that entire period are what the Social Security Administration is going to use to calculate your actual Social Security benefit in retirement. Gentlemen, is there anything I missed in there that would be good to clarify or for the audience today?
No, that was perfect.
So hopefully that answered it. Please definitely let us know if that did not answer it. We're happy to jump offline and answer it separately as well if a little bit better description would help the audience here. Next question for you guys, and I think this just gets into general medical costs. So you think maybe even reference the planning for loved ones, for elder care, and some of our other discussions we've had in the past. But when planning to retire, how would you factor in medical costs in general?
Yeah, Paul, you want to take this one?
Yeah,
Great
I'll take
question.
that one. That is something that needs to certainly be accounted for. It is for most individuals their biggest expense. I've seen reports up to 300,000 throughout retirement will be spent on healthcare costs for an individual. So planning for that should be done with a financial plan. If you want to get more information on that, I would recommend go to bfsg.com, go to our university and find our Saving for Healthcare that we did last summer, around this time last year, has a wealth of great information to help tackle that topic a lot more.
Yeah, and just to add to that, I mean, inflation for medical in retirement, what is it, 5.3% or something like that, Paul?
Yeah.
So it's been much higher than average inflation outside of this year, but typically medical inflation is much higher.
Historically, it runs about 2 to 3 times the rate of normal inflation.
Yep.
Because I mean, correct me if I'm wrong, but I think most of the stats I've seen is that notwithstanding your insurances and Medicare and all the stuff, that most people should be planning to spend somewhere in the ballpark of $300,000 to $400,000 on medical coverage, on medical things in retirement, just healthcare in general.
Yep.
That sounds correct.
Yep.
So for all of you, I know Paul just mentioned BFSG University. I actually just posted another link into the chat box for the group in case you have not subscribed to us on YouTube. All of these webinars, our YouTube channel is really a hosting place for this webinar content. We don't expect to have 1 million subscribers ever or any of that kind of stuff. It's really meant to be a resource for all of you attendees to access any of this content. Even when our Zoom account will eventually delete the on-demand replay, they are hosted on YouTube for everybody to always have access to. So that the one that you're planning for healthcare that Paul just mentioned is loaded to our YouTube channel. For all of you in the past that have had a lot of questions on the Roth presentations, there's 2 of them on there, one very long with a Q&A like this from a past webinar, and one shorter one that Mike and I did that was only 20 minutes to talk about Roth inside a retirement plan. So definitely a good resource for everybody if you're looking for additional content across the board that we've done in the past. Next question, gentlemen, is if you were to go on disability and have a pension, are both taxed, right? Disability and pension?
I believe they are, depending on your income. The social disability that you receive from Social Security could be taxable.
And I think the next one on that is because the pension is going to be taxable in almost all cases, right? Obviously, it does depend on your income and how much you get out of the pension plan. And the next one goes right along with this. If a person becomes disabled, how does that impact Social Security benefits?
Yeah, so for someone who's disabled, you can receive benefits. Actually, unmarried children under the age of 18 or those children who are 19 and full-time in high school can receive actually Social Security benefits on a deceased or disabled workers' benefits. And that's not just children, that's stepchildren, grandchildren, step-grandchildren, or adopted children also qualify if they're considered dependents of the disabled. So yeah, I mean, you can, I can't remember, Paul, do you know when they can actually claim if it's any age, right? If they're actually disabled? That's just for children.
It's correct. So if it's before age 28, if you go on disability, you can actually start collecting the benefit as long as you have 1.5 years of work. And then there's a chart that goes based on how long you've worked. So for example, if you're age 50, you'll have had to have worked at least 7 years to qualify for disability benefits.
So next question for the group is we got a couple up votes, which is why I'm asking this one instead of the top of the queue, gentlemen, is why can't a couple with 2 working spouses who both contribute to Social Security for their entire life receive both benefits, right? If they wanted or needed 2 incomes for their life before retirement, it would seem they would need both incomes in retirement. So I think that the actual answer, guys, is you do actually receive both benefits, right? Until somebody passes.
Yeah, you can claim your own benefit and each claim your own benefit. You just can't get the higher benefits. It's what you earned or the spousal benefit or your own benefit, the greater of.
Yeah,
Right,
so
so-
if each of you qualify for Social Security based on that 10 years or 40 quarters that we talked about, you will each receive your own Social Security benefits. There are circumstances that a spouse could get higher benefits because the 50% of the other spouse is higher than their own benefits because they didn't work enough or work as much, so they would be better off to get spousal benefits. But if you qualify for Social Security, then you're going to receive your own benefits.
So let me summarize that again. So basically, if you both qualify, you're both going to get a benefit. There's actually a chance the opposite is not that the lower Social Security benefit you would not receive. There's a chance you might get a higher benefit if you didn't work enough and your spouse and 50% of your spouse's benefit would actually benefit you even further. So there's a chance of getting more, but you'll both get Social Security either way. I think the big thing to think about is I think what these gentlemen do in their financial planning process with clients is to figure out between you and your spouse and your life expectancy and family history is how do you maximize your cumulative benefit between the 2 of you, right? Like in some cases, it makes sense for both of you to wait till age 70. Other cases, maybe you both take at age 62. In other cases, maybe one of you waits till 70 and one of you takes at 62. You figure out how can you as a couple get the most out of Social Security over your expected life. And there is no magic formula, right? I think almost every online calculator says wait till age 70 because that's when you get the most benefit. But at the end of the day, if one of you is not expected to live that long, right, for any reason, maybe that's not the case, right? Maybe one of you made significantly more money. Maybe that's not the case, right? So running through this kind of Social Security analysis and this exercise, I think is something really beneficial for everybody as they're getting to that last 5 or 10 years before retirement. So they can start really thinking through the best course of action to capture the most cumulative benefit from Social Security overall. Next question, gentlemen, is if you have insurance through a union, my understanding is that at age 65, that Medicare is the primary and then the other insurance becomes secondary. I don't know if that's specific to like a union, for instance, though.
Yeah,
There are some employers that offer some sort of medical insurance in retirement, and they would be correct. So your primary insurance is going to be Medicare Part A or Part B. And then what's offered through like a union or some employers would be essentially a Medicare Advantage or Medisup plan on top of the Medicare benefits. So they are correct on that.
Excellent. The next one goes back to that 8% for delaying taking Social Security. Do you guys have any idea what the mark is for that? This is a great question, actually. Like, is it 8% on the year, or do they actually do it on a monthly basis? So like you're actually getting a little of that 8% for every month you delay. Do you know what the trigger mark is for that 8% increase? I've never actually heard that one. I want to know the answer there too.
I mean, it's 8% per year.
That's my understanding as well.
So it triggers on your next birthday per se. And it's like maybe you waited like 10 months you still get your benefit based on the last birthday. You're not getting that 8% step up. So it makes sense to wait at that extra 2 months just to capture that full 8%.
No, so you get, it's roughly about 2/3 of 1% is what you get each month. So if you go 60, if you're 68 in 6 months, you get that 6 months worth of credit, or approximately 4%.
Yep. Awesome. So it is, they do, basically
Correct.
calculate every month for you.
Yeah,
Awesome.
they calculate it every month, but the max you're going to get is 8% per year. But yeah, correct.
Great question.
Okay, so next question. This is good for the financial planning team. Who's the best person to talk about how all of this stuff works? I think any of these gentlemen, anybody on our financial planning team can definitely assist you guys, or anyone on this call with kind of talking through this benefit. That is definitely, that's what these gentlemen do for a living. And they have other resources too, that we've had past hosts for some of those really complex situations that it can introduce you to as well.
Yeah, I'll just add to that. I mean, on the how to reach us is financial planning. That just goes to a main mailbox that all the CFPs get, and really we all work as a team. Each of us have our strong suits, and we know, hey, this question is we'll funnel it to the CFP that's going to be able to help that person best. But that financial planning at bfsg.com is will reach all of us.
So the next one, just because they did all caps weight, and it's what we just talked about, it is weight. Social Security goes up 8% each year, and if you take it before full retirement, you will not get the annual increases. Just to confirm, that is accurate, right? You got to make it to full retirement age, and then every year after full retirement age, you get a 8% step up, like we just talked about. If you actually retire before full retirement age, you actually get less of a benefit. It's not about getting an 8% increase. You're getting less than your full benefit if you retire early.
You got it. Yep. You got to make it to your full retirement age. And then each and every year after that, it goes up.
So next question is, if your husband were to pass at, say, age 62 and a half, and you are still working at age 63, would I be entitled to his Social Security? And how do, if so, how do you go about making that happen?
The answer is yes, and contact Social Security Administration to get that started.
Yes, and if you wait till full retirement age, you'll get 100% of the benefits, and before that, your benefits might be reduced, if I recall correctly.
So next question is a clarification on something that we've answered earlier. Is if you have a pension and then are approved for disability, would your disability benefits on Social Security be reduced?
Not quite sure on disability, but I'm looking that up. I don't know that off the top of my head.
Yeah, so while you find that, Mike, let's get with the other two. Let's get to the next question we have to keep this going is, do I have to enroll in Medicare? Right, I'll turn 65 in 3 months. I'm still working and getting health insurance through my work. Like, do I really need to enroll?
You need to still file an application with them. You can choose not to enroll, and you can delay that, but you at least want to notify them and delay and still want to file that application and let them know that you're delaying it. So that way, when you do retire, say at 67, 68, then you'll have that triggering event to enroll at that time into Medicare.
And you don't get penalized by not enrolling in a timely manner.
That's the big thing right there, is you want to avoid the penalties for Part B are very steep. And so you at least want to file that application, even if you're not going to take it, just to make sure you're avoiding those penalties.
Yeah, and I just put up the late enrollment penalties for Part B on the screen. It's pretty steep, so.
Okay, next question is a good one actually for those with children. What is the youngest age that Social Security starts counting? Like you're contributing to it, like i.e. when should my children start working so they can start paying into Social Security?
Honestly, as long as they're working and they're getting paid
A W-2, not under the table.
That's what I was going to say. It's not under the table, whether it's 1099 or W-2, and there is Social Security taxes on their paycheck, then that starts that clock for the 10 quarters or the 35 years worth of earnings.
Yep. So the sooner or later that they're able to work, age 16, 18, as soon as they can collect a paycheck and get W-2 or 1099 and file all their taxes themselves. But basically as soon as they need to file a tax return, because they have wages, they are going to be eligible for Social Security. Next question comes down to do you file, I think we've already addressed this, but do you file for Social Security and Medicare at the same time? And the answer is potentially, but not necessarily, right? It really
Most of
depends.
the time, no.
Yeah, most of the time, well, because you can apply for Social Security between 62 and 70, Medicare you become eligible at 65. Keep in mind, if you already applied for Social Security earlier than 65, then you'll automatically get enrolled into Medicare Part A and B when you reach 65.
Hey,
Next question.
Chad, before you jump to that, so for disability, excluded from the consideration in reducing disability are the following: VA benefits, needs-based benefits, private pensions, and private disability insurance. So private pensions do not reduce disability.
Yeah, perfect. Thank you, Mike.
Yep.
Next question is onto RMDs actually. At what age do you require minimum distributions kick in, causing you to have income as a distribution from your 401k or employer sponsored plan? It's a great question. So that is age 72. It used to be, as many of you on the line may recall, age 70 and a half. That was actually recently increased a couple of years ago to age 72 going forward. There is discussion about that moving up again to potentially 73, 4, or 5. So definitely stay tuned if you're getting close to those ages. But as of today in 2022, RMDs start at age 72. Next question is, who should we talk to if about thinking to switching from a regular 401k to a Roth 401k? I think that's easy. Talk to the probably two most important is your financial planner or financial advisor and your accountant, right? That it could be, depending on your income, a tricky situation to figure out what is the best place for you to save. And again, your financial planner and your CPA would be your best resources from a tax perspective. Next one is if your spouse has a pension, can they still receive Social Security benefits from your Social Security while alive and after you pass away? Understanding that it will likely be reduced due to the WEP.
Let me jump to
that. I mean, I think the answer there, guys, is yeah, if it's a private pension, it's not going to impact your spouse's ability to collect your Social Security when you have passed away.
Well,
Correct.
what happens is that there is a government pension offset. So if your spouse is a widow, their Social Security benefits will be reduced by 2/3 of the pension that they receive. So it could potentially go down to zero. It's called the government pension offset.
Yep.
Yeah. GPO. Yeah.
Next question is an HSA worth investing in for Medicare?
I think a HSA is a great savings vehicle. It's triple tax free. You save to it, grows tax deferred. It's tax free withdrawals as long as it's for qualified health expenditures. So I think it's a great savings vehicle personally. I don't know if Paul, Arash, you want to add anything to that?
If you've got one, max it out and try and save it for retirement. It's certainly a great, the best option out there to offset the largest expense you're going to have in retirement.
Yeah, that's
Absolutely.
the key. I think Paul mentioned it's a savings vehicle. It's not, you want to have it invested. We see so many HSAs, they put it in there and then it sits in cash. So you want to have it invested, and then you really want to try to not touch it until retirement and using it for, as Paul mentioned, your greatest expense during retirement being healthcare.
So next one is, you think on inflation real quick, is are there increases for inflation? I think especially topical with inflation around, call it 9% today. How does inflation impact Social Security benefits?
So yeah, there's what's called a COLA, cost of living adjustment, that is done each year on Social Security. It's based on one of the CPI indexes is what it's based on. And it can be beneficial. I think this year was like 5.5%, if I remember right, for 2022.
5.9 or something like that. Yeah,
Yeah.
right around there. It is a little different calculation. It's not like core CPI. It's a different calculation on how the government figures it out. But yes, there is a COLA adjustment each and every year.
Okay, so the next two are both going to be due to calculations. The first one is, any insights into how your Social Security payment is calculated? Other than, I think we've already talked about working 10 years, the best 35 years. Like, is there any other type of math or formula? And I think you mentioned it's pretty complicated.
Yeah, they take a process called the average index monthly earnings, AIME for short, AIME. And it's not something that in my career I have quite been able to figure out how the formula works, to be 100% honest. And then based on that, creates what's called your PIA, your primary insurance amount. That's essentially the benefit you receive at full retirement age. So,
Yeah, if that person really wants to get into the weeds, have them email us directly. But
yeah,
Paul's exactly right. It's they take those highest 35 years, add those earnings together, divide by 420, then they take the number of months in that 35-year period to arrive at that AIME that Paul's talking about. So it's a complex calculation, and we can go into that, but for the sake of time, I don't want to dive too far into that.
So then, a little bit different, maybe a little easier question is, any insight into how Social Security is calculated at retirement for somebody that's receiving disability? Like how you think disability might impact their regular Social Security? We got crickets. I think Mike's pulling it up. So, go ahead.
I'm not quite sure I'm understanding the question here, because Social Security benefits, there's 3 separate benefits. There's your general benefit you receive, there's a disability benefit, and there's the survivor benefit. And so if you're on the disability benefit, when you can switch to the traditional Social Security benefit if that's higher, once you hit your age to qualify for Social Security.
Yeah.
So I think I think the summary is you're going to collect whichever benefit's highest, but you're not going to get your disability benefit, which is through Social Security, and your regular general Social Security
Correct.
benefit. You just get whatever is the better benefit to you.
Correct.
Okay, perfect. Next question is there any legislation in the works to potentially have Medicare include dental, vision, etc.? At least that you've heard of?
Not
that we heard of, but keep in mind, original Medicare Part A and B doesn't cover it. But if you get Medicare Advantage plans, some of them have the dental and vision included. So that is one option. But legislature-wise, I haven't heard of any.
Yeah, in the Inflation Reduction Act, which was just passed by the Senate on Sunday and looking like it will be passed by the House this Friday and across the president's desk this weekend, out-of-pocket spending on drugs is capped at $2,000 a year. I know that wasn't specific to this question, but there is going to be an out-of-pocket cap on drugs of $2,000 a year. So just something to be aware of. But yeah, in that bill there was nothing specific about hearing or vision or anything like that.
Next question I have with thumbs up here is I have a law enforcement pension and benefits. Does the medical benefits part stop once I hit Medicare, Medicaid age?
They should not. Well, it depends. If you're talking, the pension can start when you're retired. You should have retirement health benefits most likely. And in that situation, those should continue once you have Medicare, Medicaid. Those just act essentially in place of like a Med Sup or a Medicare Advantage plan.
Yeah.
Next one is I'm going to do the easy one first. Is do you know if there's a current maximum Social Security payment?
Yeah, the maximum payment right now, if you're taking it at full retirement age, that is $3,345 per month. If you delay until age 70, the max monthly benefit is $4,194 for 2022.
Yeah. And that's kind of what this slide was talking about is, I mean, over a certain wage base, you start getting capped out. And that's why Social Security becomes a smaller and smaller percentage of your replacement rate of what you need in retirement. And that's why it's, especially for higher income individuals, it's so much more. I mean, it's important for everyone, but especially for higher income, especially over the 147,000, you can see roughly. Where the blue, it's a bigger and bigger percentage that you need to save in retirement accounts and other savings. But for everyone, I mean, you still need savings. It's very hard to just rely on Social Security to replace your income.
Thanks, gentlemen. So, and this is actually the last question I have in the queue. Is I am collecting half of a divorced spouse's Social Security benefit, recognizing no longer available, but I qualified, born in the early 1950s. I was told I have to reapply at my 70th birthday. Is this true? This person's unable to see their projected Social Security Administration income on the website. And is there any concerns this person should have?
So the answer is yes, this is true. Based on the age they were born, they may be on the file and suspend option, which is no longer available depending when they collected. And if that is the case, you want to check at the 70th birthday, because if you're collecting on your divorced spouse, you're getting their benefit. Your benefit still theoretically is growing at 8% per year until age 70. If you're under the file and suspend strategy, which is what this might be under. So there may be truth to this, because you may actually get a bump up in pay at age 70. So definitely something you want to look into.
Awesome. Thank you, gentlemen. So again, that was the last question. Any closing remarks before we conclude today?
No, I think as you mentioned, I mean, Chad, there's a bunch of additional slides at the end of the deck to look through if you've got questions. I mean, they range from the health of Social Security program. We just did a recent blog on that, to what the premiums are for Medicare Part B for different people at higher incomes and so on. Also, resources are in there to help with Medicare for California residents and other states as well, to sort through the slog that is Medicare. So just check out the end of the slide deck as well for additional resources.
Thanks, everyone. And we hope all of you have a great end of your morning or afternoon, depending where you are across the nation. Thank you, everyone, for attending today's webinar. We hope you enjoyed this series. Have a great day.